I was waiting for a lane at a bowling center in the spring when two guys at the next table started arguing about who owns the Professional Bowlers Association. One of them said a private equity firm bought it for $90 million. The other said 60. They were both wrong, and I understood why. For 7 years, the answer to that question has been the same 3 words, repeated by every article written on the subject. Terms not disclosed. It turns out the terms were disclosed. They've been sitting in a public filing the whole time, and the number is so much smaller than anyone guesses that it reorganizes the entire story around it. To understand how we got here, you need the history of professional bowling in America, and that history is stranger than the argument. The company that owns the PBA today is called Lucky Strike Entertainment. It used to be called Bowlero. Before that, it was Bowlmor AMF, and before that, it was AMF, the company that put the automatic pinsetter in every alley in America in 1952. It trades on the New York Stock Exchange under the ticker LUCK. It runs 365 locations, and the thing almost nobody understands about it is that it isn't really in the bowling business at all. It's in the real estate business. Bowling is just what happens on top of the asset. Start with the bet, because the bet is genuinely one of the strangest origin stories in American business. In September of 2014, Thomas Shannon told Infomercial magazine how he got the idea. His words: as an MBA student at Darden, he'd studied the successful buyout and turnaround of bowling company AMF. It took him 3 years to arrange the purchase. He sat in a business school classroom and studied a leveraged buyout. That's the formal term, LBO, borrowed money against the target's own assets of a bowling company as a case study. Then he went out and bought that same company. The case study didn't end well for the people in it. In 1996, Goldman Sachs bought AMF for $1.373 billion, and roughly $1 billion of that was debt. AMF was, at that point, the dominant name in bowling equipment and lane operation. Brunswick was the only real competitor of any scale, making the pin setters and balls and shoes that defined the sport since the mid-20th century. That ratio of debt to purchase price is the whole story of what came next. On July 2nd, 2001, AMF filed for Chapter 11 with about $1.2 billion in debt and default. It came out the following March. The unsecured creditors got warrants and no cash. The equity went to zero. Shannon's side of the trade started small. In 1997, he bought a bowling alley called Bowlmor for $2 million, financed with a small business investment company loan and a note from the seller. By his own account to Gothamist, it was doing less than $1 million a year, and it was losing money. Then 2013. AMF was in bankruptcy for the second time, and the investment bank Moelis ran the sale. It contacted more than 150 parties, more than 50 signed non-disclosure agreements, and every single one of them walked. All potential purchasers ultimately withdrew, and part of what scared them off was the leases. Nobody wanted it. So Shannon didn't buy it. This is the part that gets told wrong constantly, and I want to be exact, because there's a number circulating that says he paid $310 million for AMF. That number is fiction. No such purchase happened. What actually happened is better. He partnered with the junior creditors, the ones furthest back in line, and together they paid the senior creditors in full using borrowed money. Leveraged buyout structured as a debt finance merger, a $260 million facility from Credit Suisse, plus a $50 million rights offering. And for contributing Bowlmor, his own company, into the deal, Shannon took 22.47% of the combined business. The merger closed on July 1st, 2013. He paid no cash. He put in a company he'd bought for $2 million 16 years earlier and walked out with almost a quarter of American bowling. That's the bet, and it worked. Now the trap. And the trap has a name worth learning before the numbers arrive. In the record business, there's a mechanism called recoupment. It works like this. A label hands an artist in advance. The artist thinks they've been paid. They haven't. They've been loaned money against their own future earnings, and every dollar of royalty they generate goes first to repaying that advance. The cruelty is in the compounding. If the costs charged against the account grow faster than the royalties coming in, the artist's debt gets bigger every year. While they work, they never reach the principal. They can have a hit record and owe more than the day they signed. That's recoupment. Hold on to it, because Lucky Strike Entertainment has one on its balance sheet, and it isn't a metaphor, it's an audited line item. In October of 2023, the company sold the land and the buildings under 38 of its bowling centers for $432.9 million and rented them right back. That transaction has a name, a sale-leaseback. You sell an asset to raise cash, then immediately lease it back from the buyer so operations continue uninterrupted. The buyer was VICI Properties, the Las Vegas landlord that owns the ground under Caesar's Palace and the MGM Grand. We've made a whole video about that deal, and it's still up and it's still true. This isn't that story. This is what happened next. And it's visible for the first time in a filing that didn't exist when we made that video. And here's the mechanism. The company's own accountants concluded that the transfer was not a sale for accounting purposes because control of the underlying assets remained with the company. They never really sold it. They mortgaged it and called it a sale. So the $432.9 million doesn't sit on the books as sale proceeds. It sits there as something called a financing obligation, a debt. And that debt does not go down. At the close in 2023, it stood at $432.9 million. By the end of June 2025, it was $449.215 million. By the end of March 2026, $455.59 million. 2.5 years of paying rent, and the balance went up by more than $22 million. Now the part that proves it. In the most recent quarterly filing covering 9 months, the company paid $24,682,000 against that obligation. All of it interest. The principal portion is zero. And it isn't that the principal line says zero. The principal line does not exist. It isn't in the table. That could be dismissed as a quirk of formatting, except for one thing. The very same table, a few rows up, shows the company's finance leases. Those have both lines. $20,472,000 of interest and $1,503,000 of principal, right there, in the same table. The finance leases are being paid down. The financing obligation is not, because it can't be. The interest accrues faster than the rent retires it. That is recoupment, an obligation that grows because the payments never reach the principal. Same machine, different industry, and it's sitting in a filing signed by auditors, and the terms make sure it stays that way. The rent started at $31.6 million a year and escalates every year by the greater of 2% or inflation, capped at 2.5%. There's no clause that takes it down. The company itself judged the accounting term of that lease at 55 years because it assumed all 6 5-year renewal options were reasonably certain to be exercised. And there's no fallback because they don't own anything to fall back on. 17 of 365 locations, 4.7%. Everything else is rented. So where did the $432.9 million go? This is where the machine closes. Between fiscal 2022 and fiscal 2025, the company spent $453,914,000 buying back its own stock. That is 104.9% of what it raised selling the ground. Add $62.5 million in dividends and the figure reaches 119%. They sold the dirt under 38 bowling alleys and handed all of it, and then some, to shareholders. And they said so. The 10K's own stated purpose for the VICI transaction includes the phrase, return value to shareholders. They sold the ground to buy the stock. The rent stays forever, and it grows. If that sounds like a modern private equity invention, it isn't. It's the house style. In 2004, AMF sold the land under 186 of its centers to iStar for $254 million to climb out of its first bankruptcy. It was still paying that rent when it went bankrupt the second time. In 2014, Bowlmor AMF bought Brunswick Centers and financed it with another iStar deal, $200 million against 58 centers, 2004, 2014, 2023. Same move, 3 times, 22 years. The ground goes out the door, the rent comes in the mail forever. Now watch what it did to the actual company. In fiscal 2023, operating income was $200.8 million, and net interest was $110.851 million. 55% of operating income went to interest, and the company posted net income of $82 million, the only profitable year in the set. Then VICI closed in October of 2023, and in fiscal 2024, operating income fell to $91.59 million, while interest climbed to $177.611 million. Interest was 194% of operating income. Net loss, $83.581 million. Interest jumped $66.76 million the year they sold the ground. Fiscal 2025, same shape. Operating income $137.187 million. Interest $196.371 million. Net loss $10 million. Added up across 4 fiscal years, and the cumulative net income of this company is negative $41.5 million. The bowling works, the balance sheet doesn't, and here's the tell that the bowling isn't even the point anymore. Bowling was 50% of revenue in fiscal 2022, then 49%. Then 48%. In fiscal 2025, it was 46%, $549.895 million, down 1.4% from the year before. Not down as a share, down in actual dollars. Meanwhile, the arcade games grew 16% and food and drink grew 6%. Total revenue $1.201 billion. In December of 2024, the company changed its name from Bowlero to Lucky Strike Entertainment and dropped the word bowling out of its own name. There's one more number from fiscal 2025 worth sitting with. Pre-tax income was positive, $41.483 million, except inside that number is a $101.484 million non-cash gain on an earn-out liability, and the 10K explains why the gain happened. The decrease in the company's stock price in fiscal 2025. Strip it out and pre-tax income is negative $60 million. The only reason the year looked positive is an accounting gain they booked because their own share price fell. Now let's talk about what the room costs to run, because this is the number that made me stop. The company's own 10K says location payroll and benefit costs for fiscal 2025 were $284,131,000, and that 11,854 people work in the operation of its locations. Divide one by the other, $23,969 per person per year. All in, not a wage. That's the entire loaded cost, benefits, and payroll taxes included of employing one person in one bowling center for 1 year from the company's own two numbers. Of a total workforce of 12,565, 9,367 are part-time, 74.5%, 58 are union, less than 0.5%, and the staffing model is in the filing too, verbatim: a location general manager, 2 operation managers, a facilities manager who oversees the maintenance of the facility and equipment, and approximately 20 to 30 associates. 1 facilities manager for the whole building, every pinsetter, every ball return, every lane. If you've ever stood at a foul line waiting on a jam and wondered where the mechanic went, that sentence is your answer, and it's in a document filed with the Securities and Exchange Commission. In May of 2026, the company announced labor optimization actions to address what it called elevated payroll expense. In the same press release, it disclosed $8.3 million of share buybacks, 1.1 million shares at an average of $7.29, and another dividend. And this is the point where the story stops being about a bowling company and starts being about you, because everybody watches the top line. What the building takes in on a Saturday, what the league brings in on a Tuesday, what the register says at close. Almost nobody audits the second number, which is what's left after everyone with a prior claim has taken theirs. The landlord has a prior claim. The lenders have a prior claim. The shareholders got theirs first, out of the proceeds of the ground itself. What reaches the room and the people in it is whatever survives that queue. That's the whole game, and it's not unique to bowling. It's just unusually visible here because these people have to file, which brings me back to the two guys arguing about the PBA. On September 9th, 2019, Bowlero bought the Professional Bowlers Association. Not a stake. The whole thing. The governing body of the sport, the tour, the name, the organization founded in 1958 by Eddie Elias, the one that turned Don Carter and Earl Anthony and Walter Ray Williams Jr. into household names during the decades when the Professional Bowlers Tour ran on ABC Sports every Saturday afternoon. And the prices in the audited financial statements inside the S-4 filing the SPAC used to take the company public in 2021 in a table of 2020 acquisitions and thousands of dollars. $8,438,000. Consideration was cash from available cash on hand. $8.438 million. Out of pocket. No financing. For the entire governing body of professional bowling in the United States. The reason nobody has this number isn't that it was hidden. It's that Bowlero was private in 2019, and its first annual report as a public company covers fiscal 2022 and 2021. Fiscal 2020 appears in no 10K that exists. Everybody looked at the press release, the 8Ks, and the annual reports. The number was in the prospectus the entire time. 2 months before they bought the sports governing body for $8.438 million, they paid $5.375 million for one bowling center in Michigan. The PBA cost barely more than 1.5 bowling alleys. And in the fiscal year Bowlero went public, it paid Thomas Shannon $67,566,882 in total compensation. $67.5 million to one man in 1 year, against $8.438 million for professional bowling itself. $67,566,882 divided by 8,438,000 is 8.007. They paid one man in 1 year 8 times what they paid for the entire sport. Both of those numbers come from filings signed under penalty of law. There's no estimate in that ratio, no adjustment, no asterisk, and it keeps going. Shannon's transaction bonus alone, $28,456,250 for getting the deal done, was more than 3 PBAs. The company's own balance sheet valued the trade name Bowlero at $66.9 million and the trade name PBA at $3.1 million. The word Bowlero was worth more than 20 times the sport. The PBA's own chief executive that year, Nicole Weinberger, made $253,406, including $50,000 in severance. She resigned. Shannon out-earned the head of the PBA 267 to 1, and the company lost $29,934,000 that fiscal year. Shannon and one other executive were paid $91.6 million between them, 3.1 times the company's entire net loss. What did they think they were buying? They wrote it down for investors. In the SPAC presentation, the PBA is described as a profitable standalone venture that effectively is hundreds of hours of free marketing on linear TV. Their words, free in quotation marks, in a document handed to the SEC. They didn't buy a sport. They bought an infomercial, and they said so in a filing. That valuation settles in real time. In the fiscal 2025 10-K, the sentence calling the PBA a strategic part of the company's operations is byte for byte identical to the one in the 2024 10-K, and it sits inside a bullet-headed diverse product offerings immediately after the in-location arcade games and the food and beverage. The PBA is filed between the arcade and the nachos. It's 1.88% of a $1.15 billion company, and the carrying value of that trade name today is $549,000. There's one figure I want to handle carefully, because two different tiers of evidence meet here. 11 league bowlers are suing the company in federal court in Seattle. Their complaint alleges that after acquiring the PBA, Bowlero was able to almost immediately decrease its planned marketing spend by roughly $10 million annually. That is an allegation in a lawsuit. It is not proven, and the company disputes the case. But set it next to the price, which is audited and certain, and the arithmetic is hard to ignore. $8.438 million against $10 million a year in avoided marketing. If that allegation is true, the PBA paid for itself in under 11 months. One of those numbers is a filing. The other is a claim. The line between them is the whole discipline. So who owns this thing today? Tyros, the investment firm, holds 72,548,981 Class A shares. That's 79.9% of the entire public class, and it carries 10.6% of the vote. Thomas Shannon holds 6.4 million Class A shares and all 74,803,290 Class B shares. Class B carries 10 votes each. Shannon controls 89.4% of the vote. Tyros owns 4/5 of the public stock and has 1/10 of the say. Shannon is the company. He's taken cash out exactly once. Between January and March of 2023, he sold 2.4 million shares under a pre-arranged plan for $34,968,715, an average of $14.57. The stock closed at $7.27 on July 16, 2026. He sold at twice today's price. Since then, he's bought 64,000 shares back. He sold 38 times more than he's bought, and the balance sheet he's left holding is this. Gross debt of $1.776 billion, finance leases of $427.992 million, the financing obligation $455.59 million and climbing, operating leases of $605.543 million, $58.654 million of cash, a stockholders deficit of $362.77 million, which got worse this year. Through 9 months of fiscal 2026, revenue was $941.37 million, operating income was $127.2 million, and interest was $154.253 million. Interest exceeds operating income. Again, mid-year they cut full-year guidance by about 17%. So here's the inversion, and it's the thing I'd want anyone who bowls to understand. Lucky Strike Entertainment is not a bowling company that happens to own real estate. It's a real estate and capital structure business that operates bowling centers to service the ground rent. Bowling is 46% of revenue and falling in absolute dollars. The ground is 100% of the obligation, and the obligation grows. The land was always the asset. Bowling is just the tenant. The company took the word out of its own name, which is the most honest thing it's done. Now, the sourcing note, because there are 3 things this record can't support, and the reason it can't is itself the finding. The first one is a limit I have to put on this entire story. American bowling centers fell from 6,148 in 1986 to 3,154 in 2023, a 49% collapse measured by the Census Bureau the same way both times. Robert Putnam wrote about the cultural stakes of that decline in his book Bowling Alone, which used league bowling as a primary measure of collapsing civic engagement in America. But Bowlero didn't exist until 2014. The decline of American bowling predates this company by almost 30 years. So I'm not going to claim private equity killed bowling because the arithmetic says it didn't. They didn't cause the decline. They bought it, and they have been extremely good at monetizing what was left. Those are different accusations, and only one of them is true. The second is the prize money, and here the absence is the evidence. The PBA does not publish a season total prize fund anymore. Not on the tour schedule, not in the season pages, not in the rule book. I went looking for a clean comparison between 1963 and today, and it cannot be sourced, because one end of it no longer exists. In 1963, Sports Illustrated could print the season total. It was $1,050,000 across 38 tournaments, about $11 million in today's money, and Harry Smith earned upward of $75,000 that year, more than the baseball MVP Sandy Koufax and the football MVP PYA Tittle combined. Under Bowlero, the PBA discloses less about its own prize money than it did in 1963, and I want to be scrupulous about one thing, because it cuts against the easy version of this story. Prize money did not fall under Bowlero. It rose. Records have been set under this ownership. The long decline in what a bowler earns in real terms is a 60-year arc, and it isn't theirs, and that. The third gap is the biggest, and it's the one they're allowed to have. Lucky Strike Entertainment has been a public company for 4 years. It has $1.2 billion of revenue and 12,565 employees. And on the cover of its fiscal 2025 annual report, the box marked Emerging Growth Company is checked. That status is meant for young companies finding their feet. What it does is switch off disclosure. There is no CEO pay ratio in either proxy. No pay versus performance table, no critical audit matters, no auditor attestation on internal controls. I checked for all four. None of them are there, and none of them have to be. The company knows exactly what it's holding. Its own risk factors say that once we are no longer an emerging growth company, we will be required to comply with the independent registered public accounting firm attestation requirement. And there's a reason that matters here specifically. In fiscal 2022, the company disclosed in its own annual report that its disclosure controls and procedures were not effective because of material weaknesses in acquisition accounting, in accounting for fixed assets, in certain financial reporting disclosures, and in system access controls to establish segregation of duties. That's the same fiscal year Shannon was paid $67.5 million. KPMG, the company's auditor since 2002, was dismissed on October 21, 2022, with those weaknesses still open. And now the part that keeps this honest, because it cuts the other way, and it's true. The weaknesses were remediated by July of 2023. There has never been a restatement of this company's financials. The fiscal 2025 audit reported 0 critical audit matters. No regulator has brought an enforcement action. Nobody caught them at anything, because as far as the public record shows, there was nothing to catch. Every number in this video came out of their own filings, voluntarily, accurately, on time. That's what makes it worth telling. Nothing here is a scandal. There's no fraud, no cover-up, no short seller report, no smoking gun. This is all just the deal, disclosed exactly as the law requires, and the law requires less of them than it appears. So the two guys at the next lane were arguing about the wrong number. It was never 90 million, and it was never 60. It was $8,438,000, paid in cash, out of pocket, for the entire governing body of their sport. The organization that Eddie Elias built, that put Don Carter and Earl Anthony on television, that made professional bowling a fixture of American Saturday afternoons for decades. In that same company, one man's pay for 1 year was 8 times that, and the ground under the building they were standing in had already been sold for $432.9 million and spent on stock, and the rent on it will be paid every month for 55 years by whatever happens on those lanes. The debt on that ground has not gone down by a single dollar. By the company's own filing, it never will. They finished their argument, got their lane, and bowled. The building was already somebody else's. It has been for years.